This video will cover the aggregate supply and aggregate demand model. We'll review an outline of the big picture, which we've seen before, but I'll reiterate to make sure we're in the right frame of mind. We'll discuss some preliminary concepts such as money, neutrality, and nominal rigidity. We'll introduce the aggregate demand curve. We'll recall, and I'll reintroduce, the long-run aggregate supply curve, which is sometimes called potential GDP or full employment GDP, something we've seen before. And then I'll introduce the concept of the short-run aggregate supply curve. Then we'll use the aggregate supply and aggregate demand model to explain historical events, such as stagflation from the 1970s and ordinary recessions, where ordinary recessions are defined as roughly 2 consecutive quarters of negative GDP growth. I say roughly because identifying a recession is a very subjective process. We'll use the aggregate supply and aggregate demand model to explain how policy actions such as the Fed's monetary policy and the federal government's fiscal policy can steer the economy back to full employment GDP faster than the self-corrective mechanisms that are in the economy. Then we'll critique the aggregate demand and aggregate supply model to give us better context of what's going on in that model. So now let me move over to paper and pencil to show you the big picture again. Then we'll move back to slides. Okay, so let's look at the big picture. It's important to get a look at this big picture because it'll help us transition into this chapter of aggregate supply and aggregate demand. And let me show you how we can transition. So over time we have GDP, real GDP, and it wiggles as it grows. And so this, let's be specific here, real GDP, and this is time, and that we have booms and busts, and we have this potential GDP is what the economy can grow at if we get rid of this business cycle. And this business cycle is often referred to, especially in these types of chapters, where chapters that talk about aggregate supply and aggregate demand, they talk about these as being short-run fluctuations in GDP. And remember, the goal is to try to get rid of that. And if we get rid of that, we can, like I said before, we can maybe even increase and ramp up the slope of this potential GDP line, and we'd all be better off. We wouldn't be in unemployment, and we wouldn't be in an inflationary environment at various times. So how does this translate into the chapter of aggregate supply and aggregate demand? Well, it's not that hard. We're going to get rid of this component, the time component. We're going to have real GDP here, and we're going to have the price level here. And they say aggregate price. So this is kind of like P and Q, like we looked at with individual markets, where we had a price and the quantity. Well, real GDP, think of that as quantity. It's a bit like, P times Q. If you across the entire economy, it's price, aggregate price level. In this aggregate price level, I'll just go to call it price level, but it's an aggregate price level, like the CPI index, which is a basket or an index of prices, or the GDP deflator that we saw, that it helps us keep track of prices on an aggregate for the aggregate economy. And then we have the aggregate economy here, the real part of the economy, P times Q, where I have to be careful here. So it eliminates the effects of P. So we're just looking at real GDP, which is conceptually like a quantity component. Okay? So normally nominal GDP is P times Q, but when we have real GDP, we're kind of focused on Q. So again, it's P to Q, like we've been doing. And see this straight run potential GDP? That's basically our long run aggregate supply curve. And we'll talk about how we'll define that a little more. And then we'll have an aggregate demand curve. And that aggregate demand curve kind of looks like a demand curve for the market of an individual good, but it's not. And in the past, I've said, look, you can conceptually think of an aggregate demand curve as being the sum of all goods and services in the economy and its demand. So that when price goes up, things tend to contract. GDP would contract. And when prices come down, you would have more GDP. that explanation for the slope of the aggregate demand curve as being related to the slope of the demand curve for a single good or item is very misleading, and I'll clarify that when I develop the aggregate demand curve in a few minutes. Okay, so then we have an aggregate demand curve for the entire economy, and then we also have a short-run aggregate supply curve, and this is something we haven't seen before, a short-run aggregate supply curve. And this takes a little bit of development, this short-run aggregate supply curve. And what we're looking here is, for example, if we have a very strong economy and aggregate demand goes up, you can think of it as either going out to the right or going upward, right? We start at point 1 in equilibrium. We end up at point 2 here, for example. And we might ask, and we'll cover later, what actually causes the aggregate demand curve to shift. But when it shifts, you get these short-run fluctuations from full employment, GDP, or potential. So this gap right here is nothing but one of these gaps, for example, because we're above potential, which is the straight line. So this comes right here, this straight line. And then when we have this economic boom, here we have it above potential. And so that's a short-run fluctuation, because ultimately we're going to get back on the long-run aggregate supply curve. So in the long run, we'll always be on that line right there. So short-run fluctuations. So how does the economy get back? How does it snap back to the long-run aggregate supply curve? That's where I was saying, well, you can wait for self-correcting mechanisms, which we'll discuss in this chapter, or you can use fiscal policy or monetary policy to move the aggregate demand curve back, for example, is one way. You can actually move the aggregate supply curve up this way if you wanted to, but we want to learn how to move these so we can get back to long-run potential faster. And in this case, we're going to get rid of the potential inflation. You see the aggregate price level is going up from this increase in aggregate demand. Then if we had, for example, we started at point 1, and we had for some reason a jolt to the economy where the aggregate demand curve moved to the left, we'd be down here at point 3, for example, and that would be, correspond to a recession at this point. So we're below full employment, which almost by definition, it's telling you that we have unemployment. And so there you have the unemployment, and when you have unemployment, you have less pressure on prices. Prices tend to drop down. And so the point I'm making is this model that we've seen a bunch of times before in this course is going to be reformatted into this model of aggregate supply and aggregate demand. And so let's develop this model, and that's what the chapter is. Let me start developing the model. We'll talk about money neutrality and so on, and we'll go forward. Now, in order to introduce the concept of money neutrality, let's back up a little bit and talk about nominal versus real. And it's often couched in terms of the nominal versus real dichotomy. And so this is something that lurks behind the scenes in economics, as many things do lurk behind the scenes. But this lurks behind the scenes. It's a bit abstract. Nominal variables, let's make sure we're clear on it, are things that are measured in terms of money. So if you're looking at wages, even interest rates, which are reflected in changing money values, and prices are all nominal variables. Okay? Real variables, on the other hand, are things like physical units, hours worked, quantity of goods, the number of workers. And so nominal GDP that's adjusted for inflation becomes real GDP, which is measured in quantities. Think of it as a quantity concept. Now, I realize this is a bit abstract, trying to unentangle these two variables, but let's move forward with this idea, and let's go into the concept of money neutrality. And basically what money neutrality says is that quantity of money does not influence the real economy. And so how do we develop this? Well, let's run a thought experiment. And the thought experiment is, if the money supply doubled overnight, what would happen to the economy? Well, the real economy, output, employment, capital, equipment, technology would remain basically the same. You and I would get up and go to work every day, produce the same things. We would basically be operating the same in the economy. That's the real component. What will have changed is just prices. So the prices of goods and services will have doubled. All else being equal, those prices will have doubled, and we'll just be walking around. We're going to need a bit more money in our pockets, right? Technically double the amount of money we need in our pockets to conduct transactions. But hey, you go and you walk around and you see prices on a restaurant menu, and they're just double what they were the day before. Now, let's get a little deeper into that idea through the concept of the quantity of money. And we actually have an equation with this, the quantity of money. And I can demonstrate money neutrality from this equation. So the equation is P times V equals P times Q. Now, this is the quantity theory of money equation, and I'm using it to demonstrate money neutrality. The money neutrality is, look, money is neutral. It doesn't have an effect on the real part of the economy. So now the question is, what are these four variables and what's real and what's not? Well, M is the money supply, and the money is just money, so that's a nominal term. Then there's the concept of velocity. So money, the quantity of money, think of it as M2, times the velocity of money, which think of it as the turnover of how often a dollar turns over in the economy. And I'll get at this a bit more in a second. Well, that's, how often you and I conduct transactions using money is a real component, the real thing. Then there's the price level, which prices, that's a nominal thing. And so that's the aggregate deflator, the GDP deflator, or CPI. And then we have Q. And Q is the measure of real output. So if you're looking at, how much did you produce, the value of what you produce, the value in dollars is P times Q. But the Q, obviously, is the component part. Think of that as the number of units of goods and services. And that P times Q, which is on the right-hand side of that equation, is your nominal GDP over, say, a given year. So when you look at GDP, we often look at it for a quarter or a year. Let's think of it in terms of a year. So what it says is M times V, the money supply, times the velocity equals GDP, nominal GDP. And that's what we want to explore a little bit more. And so we're going to explore this concept by looking at how it changes from year to year. And if you take some logarithms, which you don't need to know, and you fool around with the math a bit, you can see how this money equation changes from year to year to year. And one way to summarize is at the bottom of this slide is that the percentage change in the money supply, so how much, M2, for example, grows per year, 5%, let's say, plus the change in velocity, how often you and I conduct transactions. So you can think of things as, when the economy is strong or quite active, velocity is a bit higher. And when things are slow, velocity tends to drop down a bit. And then you can go further and think, well, okay, velocity probably is like somewhat of a constant variable in a lot of respects. So we'll assume that velocity is constant shortly. Okay, so then the right-hand side of the variable says, this equation says that, look, we have percentage change in P, that's inflation, and then we have the percentage change in Q, and that's the percentage change in real GDP. That's what the Q is standing for. So let me develop this. Let me put some numbers to it, and that's where I'm going to move back to paper and pencil, put some numbers to this to make sure we better understand how this thought process, for example, of doubling the money supply overnight can influence and double prices overnight and leaving the real components fixed. So here I've written out the quantity theory of money equation, and what I want to do is let's look at an example to try to better understand how these components work. And the example is going to be simple. For now, let's just work with the top equation, which is at a point in time with like a particular year in time. And let's say that So let me bring this down. Let's say we have an economy where we only sell cans of Coke. Okay? And let's say we have 10 cans of Coke that are produced and sold, and they're sold at $2 per can. So our GDP nominally is $20. Real GDP is 10, so to speak, because that's just the output number of cans. And let's say that we have a money supply of just $5 in our economy. What that means is this $5 has to turn over 4 times. It's the missing equation. This is the missing variable. So all out of these variables, we can calculate real GDP. We can calculate nominal GDP. We know what our money supply is. For example, M2, which is checking accounts plus cash in circulation mainly. This is the unobservable component. We can back into it. And we back into it and say, look, you know, this $5 in our economy has to turn over at least 4 times to get this nominal level of GDP. So what would happen if we doubled the money supply here in our overnight example? So overnight the money supply doubles, this is 10, and we assume that the real components don't change because velocity, the number of transactions we do, you know, overall in an economy doesn't change that much. So the assumption is that this is relatively constant. It is for the most part, but you know, depending on the situation, it can change. But for now, let's assume it's constant. We're going to assume that, you know, how many cans of Coke are produced and consumed in an economy is not going to change. You double the money supply, it doesn't mean that I can produce twice as much or I can consume twice as much. That kind of doesn't make sense. So in terms of production, let's think of production and not necessarily consumption. But production is not going to double up. So what happens is your money supply is going to double. So it's that link between money supply and prices that are prominent in this example. So how does this relate to the graph we were just looking at? Well, if we have the aggregate price level here, and that's what I mean by P, aggregate prices, and we have real GDP here, and that's basically Q, and I have a long run aggregate supply curve here, which I'm going to define better. If I increase the money supply and I have a price level at this point right here, a certain price level, let's say it's price level 1, right? And I double the money supply, what happened? Well, Q is unchanged. You see that Q is unchanged at the long run aggregate supply curve. What happened? The price level doubled to say 2.0. Okay, so you can define the price level in any terms, and that's what I'm doing. I'm just saying it started out at a price level of 1, or you know, even if it you don't like that, we can put it at 2, the number that was here, and make this 4. It's just, it doesn't matter how you scale it. But the point that I'm trying to make here is, look, this long run aggregate supply curve didn't budge. When you increase the money supply, and that's something that the central bank controls, the Fed. So the point is, the Fed can ramp up the money supply, but it's not really going to change output. I mean, that would be too easy. If the Fed could just produce money, however we produce it, change reserve requirements, literally have the Treasury print more of it, it won't lead to more prosperity. And it just leads to inflation. This concept that Q, real GDP, does not change when you change the money supply is what we call money neutrality. You can change the money supply, but you can't change real output. So in a sense, money is neutral. Now this concept here that I'm showing you, I mean, I'm talking about an overnight example of doubling the money supply, and that what would happen is prices would double. In reality, there's some distortions that go on in the short run. And that's what the short run aggregate supply curve that I had gone out like this will show you in a little bit. I want to develop the aggregate demand curve first, but this aggregate supply curve is based on the fact that, look, change the money supply. This is certainly, the M and the P concept are certainly bound together very, very tightly. But in reality, quantities can change in the short run. These things, some of these things can change. We'll assume V is constant for simplicity. And that what happens is quantity changes, and you end up, for example, out here. And then we got to find out, well, how do we get back? How does the economy correct itself back to this long run aggregate supply curve over a longer period of time than, say, a day? Those are interesting questions, and that's what's going to pop up a little later on. But for now, let's move on to the idea of developing an aggregate demand curve, the downward sloping curve, and then I'll develop this long run aggregate supply curve, which is there's this vertical line. Then I'll have to develop this long run aggregate supply curve, which takes a little bit of time, in order to better understand, exactly what's going on here. And that, look, prices and money are really bound tightly, but they're not perfectly bound. And we want to look at the issues that cause that relationship to pull apart a bit. So now, let me transition over to looking at aggregate demand. Okay, now in this part of the video, I'm going to cover the aggregate demand curve, and I'm going to look at the slope carefully and compare and contrast it to the market, say, of oranges, an individual market. Then we're going to look at wealth effects, interest rate effects, two different versions of the Fisher equation, which become important here. Then we're going to look at shifters in the aggregate demand curve. So that's the outline. Now, let's look at this carefully right here. Here's the downward sloping demand curve. It looks like the demand curve for an individual market, like we looked at earlier, where we looked at, say, the market for oranges, and we looked at price, and we looked at quantity. Okay? But this is an aggregate demand curve. It's a sum of all goods and services purchased. So it's the sum of consumption plus investment plus government expenditures plus net exports. But the thing is, this slope is not just a normal slope that we see with an individual market. And that's the point that I got to make here. So let's look at the demand curve for oranges. And so here we have quantity, and here we have a demand curve slopes down. And the question is, well, why exactly did this slope down? What were we assuming? You kind of know intuitively when price goes up, consumption drops, but what's the real, additional story behind that? How does that work? Well, let's say we just start out here. We start out at this point, this P and Q, and let's say prices go up. So prices go up. We end up moving along the demand curve, remember, because we're changing something that's on the axis here. Along the demand curve, we're at a new P. So prices go up and quantity comes down. Okay, but again, what is the mechanism? Well, the mechanism is called substitution effect, where because the price of oranges go up and we have a budget, we're looking at, these prices are up. We're probably going to substitute, let's say, apples for oranges. And so we're going to go into apples is what I'm trying to say. And we're going to buy less oranges because of that. That's the substitution effect that's going on. That's what motivates and drives this negative slope in the demand curve. But over here with the aggregate demand curve, that can't happen. You can't have substitution going on here because this is aggregate prices for everything. So when the aggregate price level, the entire price level of the economy and everything in it goes up, you can't switch to another economy or to another market because all the markets have the same price effect. So we need to find other reasons for this aggregate demand curve for sloping down. It's not a substitution effect. What is it? Well, it's a wealth effect, it's an interest rate effect, and there's an exchange rate effect. So let's dig into those concepts. Now, the wealth effect works like this. Let's say we have $100 in a bank account, and the price level is just 1. Okay? We can scale the price level to whatever we want, and so we basically have real wealth at $100. But let's say the price level goes and doubles. So the price level goes to 2. Now we only have $50 in wealth. Well, when we have $50 in wealth, that's a problem for us. We tend to reduce our consumption. So what would happen is consumption here would fall off. Okay? So remember, we have disposable income equals consumption plus savings. There's a little bit of a background here. And so when our real wealth falls, that means, we probably need to save more of our disposable income, because you can either do one of two things with disposable income. You can consume or save. If our wealth drops off, we have to increase our savings. Well, why do we do that? Because in our minds, we have a target savings rate that we need to hit. Boy, our savings rate just fell because of our wealth drop. So we're going to increase our savings. Well, if we increase our savings and our disposable income is unchanged, then we're going to have to reduce consumption. So therefore, consumption drops. So the aggregate price level goes up, then it leads to consumption falling off, which is buried in aggregate demand. Okay, that makes sense. Now, let's move on to the interest rate effect, and that's a little more complex. In fact, it's complex enough that I've developed a separate video to cover the details behind it. But here's what I want to get out of it right now. When the price level goes up, we end up with an increase in interest rates. And if you notice, I'm just saying nominal rates. That's technically the nominal rate is I. And I also mean the real rate too. Your book, and most books don't really differentiate it because it's a little bit involved, but let me try to give you the gist of what you need to know for an exam, for example. And then you can rely on the video for details and additional support. And the reason for that video is, I'm going to talk about bonds in a second. We haven't really discussed bonds. It takes a little bit of while, little effort to develop a bond and discuss what bonds are to get comfortable with them. So I'll do that in a video, another video. So getting back to this point, we have prices, aggregate prices going up, nominal rates go up, which is the same as real rates. So what you're used to seeing is this. Here's nominal rates equal real rate plus an inflation premium. This is the Fisher effect. So if nominal rates are 5%, that's the rate we get maybe on a certificate of deposit or some type of savings account somewhere, say in a money market mutual fund. Then let's say the real rate is 3% and then inflation is 2%. What that means is, look, we're trying to get, we want to keep up just with inflation, so we need to add 2% on top of the real gain in purchasing power we're going to get out of this investment. So we're going to get 3%, provided we hit this 2% inflation rate to get the 5. Okay, so that makes sense, but this, we don't always know if we're going to get this. The problem with this example and using this format is we need to project what the inflation rate will be. Here's the point. So you start off at time 1. This is today, or time 0, I'm sorry. So time 0 is today. And we're going to invest our money, and we're going to invest the money for a whole year. So we're going to give up some money now, and we're going to get money back here. So you give up money and get money here. And what's going to happen is, we need to know what this inflation rate will be. Technically, this equation is not 100% right, because this represents pi by itself. This inflation premium represents current inflation rate, but we need to know what's the inflation rate over the next year. Yeah, there is a difference. And so I equals real plus pi e. See that little e for expectations. So therefore, in this example, you're going to get a nominal rate of 5%. And if you expect inflation to be 2%, then you're going to get a real rate of 3%. So hopefully your expectations pan out and you'll earn 3%. That's your gain in purchasing power. So for every dollar that you invest here, you'll get 3 cents more in purchasing power. Okay, so let me get back to the story kind of. Why can't we just say I equals R plus pi? Well, the reason why we're saying that is because this is an increase in prices right now. That means current inflation. That's not the same as expected inflation. So if we use this equation as originally specified, and we had used earlier in the course because we didn't really need to differentiate between expectations and current, then if current inflation goes up, nominal goes up, but real doesn't change. Uh-oh, that's a problem because we know consumption, investment, and net exports are a function of real rates of interest. So this by itself won't work. But if we use this model right here, what happens is the price level goes up, current inflation goes up, right? But if we assume inflation for this next year, expected inflation, remember that? So there's two different types of inflation. There's current inflation and expected, just like there's current prices and expected prices that we looked at way back when we covered the basics of supply and demand. We said what happens if the expected price changes. Well, the expected price change is not a change in this guy. So an expected price change meant we shifted the demand curves. Remember that? Here, let's get back to the story. What happens is the price inflation goes up, the price level's up. It's not affecting expected inflation. It's increasing nominal rates, and it's the real rate that goes up. So that's why I say when you see this relationship, you see an I, then it's both interest rates that are nominal and real that are going up. It has to be real because real interest rates are the only thing that really affects consumption, investment, and net exports. Now, there's also an additional story that I'm not going to cover here that's in the other video, and that has to do with bonds. And so the story that goes on in the other video is, look, when the price level goes up, you and I are going to hold more money. We're going to demand more money to transact business, because if the price level is higher, I mean, think about it. The price level doubles, then we need twice as much money in our pocket, so to speak. And when I say a pocket, I mean checking account and cash that's floating around in your pocket or pocketbook. And so how do you get that increased money? Where do you get that money? You demand more money, cash, either in your checking account or in your pocket. Where do you get it? You get it from selling the bonds that you own. So you own some bonds for investment purposes, a mutual fund, a money market mutual fund, or a bond fund, for example. Take an investment management course, and we'll go over that carefully and in detail. So what happens is you sell your bonds, and when you sell bonds, you actually push the price down. So you get a bond price that drops. What that does is it causes interest rates to fall. Now that's there's a detailed explanation behind that beyond what we want to cover. So we just want to cover the fact that, look, you can use this carefully derived Fisher equation to get at an increase in the price level for nominal and real rates that drive consumption. Okay, it'll drive them down. Okay, that's one story. The other story is that money demand goes up when the price level goes up, and that means we're going to have to sell bonds, the liquidator bonds, to hold more cash in our pocket. Well, when you sell bonds, you drive up the interest rate. Be careful, you drive up the interest rate. And so that's the important point there. That's about as far as you need to know for an exam. The details of bonds, well, that'll be in the other supplemental video to this video. There is also an exchange rate effect, and the exchange rate effect goes like this. Price level goes up, interest rates go up. We just established that, the interest rate effect. But when interest rates go up, what happens? Well, there are portfolio managers around the world. They scour the world for places that have the highest interest rates, countries that have the highest interest rates. And if interest rates go up suddenly, all else being equal, it's important, all else being equal, then what happens is money pours into that country, and if that country is the U.S., then the value of the dollar goes up. So the value of the dollar goes up. That means exports are going to go down because foreigners are going to look at that expensive dollar because they have to convert their foreign currency, euros, into dollars. And if the dollar's up, all else being equal, it's expensive. So they're not going to buy our goods. Our exports are going to fall. And since we have a higher value of a dollar, then our dollar goes further in buying euros. And so we'll import more. And so what happens is net exports over here, if you break it up into exports going down, imports going up, okay, you have interest rates going up causes consumption to drop and investment. So people buy less houses because it costs more to borrow, and businesses don't borrow as much because it's more expensive, and so they're not going to invest in property, plant, and equipment, or borrow for that matter for their inventory that they need to hold. And then we also have drops in exports and increases in imports. All of this spells an aggregate demand drop. When the price level goes up, interest rates go up, aggregate demand goes down. Okay. So now the question becomes, we covered the slope fairly well. What are the shifters? Okay, the shifters in the aggregate demand curve. Well, it's anything that happens that's not a change in prices. So what could happen? Well, there could be a coronavirus hitting. Well, that would drop off consumption, probably drop off investments. Who knows the effects of this? Let's save that, push that to the side. Just that you're going to have huge drops in investment and consumption because of that. So remember, so that's going to shift the aggregate demand curve down. There's also, and it's related, waves of pessimism and optimism that come across people over time. Even Keynes in the 1930s had recognized that, there's times when the world seems to be very optimistic, and there's times when the world seems to be pessimistic, and that change in attitude can affect consumption and investment. Okay? So those are the particular drivers of C&I. You can change government expenditures, and so the government could come along and say, well, we're going to increase our expenditures for various goods and services that they provide people, and so that would boost G up, and that boost G up would mean a shift in the demand curve. So what happens is if something like the coronavirus hits, aggregate demand drops because C&I fall off, then the government comes in and says, we're going to increase expenditures. We're going to attempt to offset this. Except the government's going to have a hard time offsetting a huge impact of this. This is most of GDP, and this is a small part of GDP. It's going to offset to some degree, but not all of it. Then if you have changes in attitudes by foreign consumers and even producers, so you're going to have changes here that are going to cause shifts in your aggregate demand curve. Other countries could experience a boost in their price level relative to the U.S., and so that's going to have an effect on exports and imports because it's going to affect the value of the dollar relative, for example, the euro. Now what we want to do is, I think we've covered everything we want with the aggregate demand curve. Let's look at the long-run aggregate supply curve next. Okay, so here we have a setup for the long-run aggregate supply curve. I'm going to use this as a segue into the short-run aggregate supply curve. I'm not going to spend a lot of time on this long-run aggregate supply curve. We basically spent a chapter developing it. Its potential GDP, full employment GDP. I'm mentioning here, or specifying that, let's just assume it's $21 trillion. So we have aggregate price level. We have quantity, real GDP. We saw not too long ago, meaning a few minutes ago, that we looked at the concept of money neutrality using the quantity of money equation. And we said, look, if we have an increase of the money supply, let's just say it goes up 10%, then in the long run, velocity is constant. Output's not going to change. And what's going to happen is you're going to have an equal increase in prices. So you increase the money supply, prices go up, but nothing real. These two things are real. Nothing happens. These two things are nominal, effectively. So nothing real happens. So you're on this long-run aggregate supply curve. Now, what are the shifters to the long-run aggregate supply curve? Well, the same shifters that we saw when we looked at potential GDP a while ago, meaning a couple of videos ago. It's going to be changes in labor. So if labor increases, this whole line, vertical line, shifts out. Decreases, shifts to the left. Increases or changes in capital and human capital will shift this out because you'll be more productive as a nation. Changes in natural resources can shift this back and forth, and that would even include weather. Okay, so it could change, you know, like El Nino could actually change weather patterns long run, or just plain natural resources. And then there's technology. Changes in technology can shift this back or forth. Now let's move on to the short run aggregate supply curve. Okay, the short run aggregate supply curve. Let us start out with a definition of it. I think that's important. It'll help anchor us into this concept. The short run aggregate supply curve tells us the quantity of goods supplied, right, in the short run for any given level of aggregate prices. Okay, what does that mean? Well, let's do it graphically. We're going to have real GDP here, aggregate price level here, and we're going to have this upward sloping short run aggregate supply curve. And what it means is, according to the definition, it's the quantity supplied here. This is quantity. Remember, this is basically Q for any given level of prices. So if we have a given level of prices, and just literally come somewhere here and put an arrow here. So this is the quantity of output for a given level of prices. Now, if the level is higher, the price level is higher, there's going to be more output in the short run. Small change in this output, it increases. If you have a higher price level, in the short run, firms will produce more. If you decrease this price level from, let's just anchor it here for a moment, then you're going to come down, firms are going to produce less. So that's basically what the definition is telling us, but we need to develop it a little bit more to get some more intuition as to how it works. Now, the key to understanding this relative to the long run aggregate supply curve we just looked at is the concept of an expected price level. And that's why I said let's anchor ourselves right here for the moment. Let's just say this is the expected level of prices. Expected price level. That's key because we never talked about expected price level when we talked about the long run aggregate supply curve. So now what you see is if we have this level of expected prices and the actual price level goes higher, say to this point, firms will increase their output. Now, why would they actually increase their output? They expected this level of prices. Prices actually rose, and then because actual prices rose, there is an increase of output. And, you know, in other words, we just didn't go straight up like this, like we had a long-run aggregate supply curve. We just didn't shoot straight up. We actually went out to the right and increased output. How does that work? Well, there's three theories behind that. One is called sticky prices, one is called sticky wages, and the other one is called misperception theory. And they're all built around this concept of an expected price level. So sticky prices, that theory says that, look, there's certain firms that are slow to change prices. And they're slow to change prices because they kind of lock up and set up their menu, so to speak, early, let's say at the beginning of the year as an example. So we start off at time 0. This is January 1. And let's say they have a horizon of 1 year in which to keep a menu and its prices fixed. And that's set there in part from social norms, and in part businesses want to keep things relatively stable. They may see their input prices go up and down, back and forth, but over the long run, you know, they have their selling price relatively stable. It'll iron out all those little ups and downs. And you don't want to have your price go up and down constantly in a restaurant, say, because your customers may not appreciate that. Now, there's other markets, by the way, that deviate from this. For example, gasoline. When you go to a gas station, well, the price changes every day. It's possible it could change even more than once in a day. That's a different market. That's a market where there's flexible prices. And so you'd be more likely to be, if everything changed like gasoline prices, we'd be more closer to a long-run aggregate supply curve like this, where there's money neutrality. But here what we're talking about is there's some prices that are sticky. You go into the same gas station and they sell candy bars, and they keep the same candy bar for $1 for a year or two. And that's just to keep things relatively smooth. And so customers expect that. They don't necessarily expect the candy bar to be going up and down in price, and that would be kind of a hassle for the employees there to keep changing the prices that are advertised on all the shelves. So they keep it relatively fixed. That's the concept of sticky prices, that there's what we call menu costs associated with changing prices. And that's literally a menu type cost for a restaurant, or changing the prices that are listed on all the shelves. So those sticky prices are based on the fact that right here at this point in time, these businesses are determining what their prices will be for the entire year. And so they're anchoring, kind of like this. They're anchoring their prices here. This is what they expect the price level to be. And they're determining their prices for the next year based on this expected price level. But what happens if the price level rises above what's expected? Well, if it rises above what's expected, well, like I said, there's going to be some firms that will just ramp up prices immediately, like a gas station. But there's some firms that lag behind because of these sticky prices. Their prices lag behind, and when their prices are lower on a relative basis to this expected price level, their sales will go up. There'll be some firms that don't increase their prices in the same market, and others that will. So if you look at the gasoline example, what happens if you have a gasoline station that's slow to update its prices? Well, slow to update its prices, and the general price level goes up. That gasoline station is going to get more business. They get more business, they're going to increase their output, and Q goes up. So it's that sticky price concept that's driving this upward slope. Now, there's a concept called sticky wages. And sticky wages is kind of like a sticky input prices. Wages are sticky. For example, you may not get a raise for a year or two in a lot of organizations. And so your wages are relatively fixed. And that's a social norm for the most part. I mean, you wouldn't, it's a hassle to get reviewed every month. And you probably wouldn't want to get reviewed every month because, one month you have a good, things are going well, and another month things are not. So you want to iron all those ups and downs out. And so you get reviewed once a year, maybe once every 2 years in order to get your raise. Well, in that time period, your wages are sticky. They're stuck at a certain price level, at a certain wage level, I should say. So if wages are kind of stuck, then if the price level goes up more than what's expected, and by the way, the wages are going to be stuck for the same idea that the prices are going to be stuck here. There's an expected price level that these sticky wages are set at. Okay, now what we're saying is, let's say things happen, the price level is different than what is expected. The price level goes up. Well, if the price level goes up, that means firms' sale prices are going up, but their costs are kind of sticky. Ooh, that's kind of nice. That means that their profit margins are increasing. These firms can raise their price along with the general price level, okay? While their wages are relatively sticky, their profit margins increase. Well, of course they're going to want to increase output. There'll be some firms that don't have sticky wages, in which case they're more likely not to increase output because they're not going to see that increase in profitability. So they're kind of like moving right up this long-run aggregate supply curve in a sense. The third thing related to expected prices is the misperception price theory. Okay, misperception of prices. I should say the misperception in terms of relative prices. That's what's important here. Yeah, so this misperception theory basically says firms see an increase. They actually see this increase in the actual price level. This actual price level goes up relative to what they expected, but they associate that only with their specific product. So they see this price level going up, but they don't realize it's the actual price level in the overall economy. They think it's related just to their product. They think that their costs, for example, are still at where the expected price level is. And so what happens is these firms increase their output when they think that their sales price is higher than what their expected costs are. Okay, so there we've developed the slope of this short-run aggregate supply curve, and that it's based on a given level of different prices, as we see across here. Okay, so what we want to look at now is what are the shifters? And the shifters of the short-run aggregate supply curve are these same items here: changes in labor, quantity of labor, changes in quantity of capital and human capital, changes in natural resource, changes in technology. All will shift, right? And so increases in all of these will shift things down to the right. The point is that shifts in the short-run aggregate supply curve are the same shifters are in the long-run aggregate supply curve, except one thing, and that is expected prices. So when expected prices increase, an increase in expected prices shifts things up. So let me get another color here. And so an increase in expected prices would shift this to the left, or you can think of it as up. But notice what happens is you're running up the long-run aggregate supply curve in the long run. Okay, so expected prices going up, that's important. You move to the left. Now, if expected prices go down, then you're moving in this direction. That's kind of like an increase in productivity. An increase in productivity is going to mean, think about it, it's going to mean that, okay, you can keep your sales price the same, but your prices are going to be, or your costs are going to be lower than normal. And if your costs are lower than normal, then you can actually produce more output and have more profitability. Now let's move on and bring all three curves into the same graph to try to explain the world. Okay, so here I have all three curves in one graph, and here we have full employment, and we're starting off in an equilibrium here. Now when you have all three curves here, I think the most important thing to discuss right up front is the idea of the self-correcting mechanism that's in the economy. And when we do the self-correcting mechanism, we'll see how these curves shift relative to each other. So again, we start right here, point 1, long-run equilibrium, because we're on the long-run equilibrium curve. There's also a short-run equilibrium, because we're on the short-run equilibrium curve. Okay, now we start from there, and let's say there's a stock market crash. People expect stocks to do poorly. The stock market crashes, or there's like a coronavirus hits. Consumption drops off dramatically. Probably investment too would drop off dramatically, and that means an aggregate demand curve shift, okay, to the left or down, however you like. And we're going to go to point 2. So when we're at point 2, we're certainly at a short-run equilibrium because we're not on the long-run equilibrium curve. In fact, we have, in this situation, a recessionary gap, meaning there's unemployment. So the reason why I like to call this full employment GDP is that we can see at this point in this gap, there is unemployment, there's slack resources in the economy, and what happens is, hey, look, prices come down. They don't come down all immediately because remember, they're sticky prices. So the prices just didn't come straight down like this. There's some firms that are slow to reduce their prices. And if they're slow to reduce their prices, when this happens, they're going to lose sales. And so when they lose sales, output drops off in this direction. Okay, so here we are at point 2. Now what happens? At point 2, the price level has dropped. There's slack in the economy. And what businesses are going to expect is they're going to expect lower prices in the future. And if there's lower prices in the future, the short-run aggregate supply curve is going to shift. Oops, call this 1 and the short-run aggregate supply curve 2. And so we move to a new short-run aggregate supply curve. We move to this point to eventually come to an equilibrium at a lower price level. So in the long run, all that changes are prices. From point 1 to point 3, no output change. But in the short run, we had some unemployment, slack resources, wages are likely to drop because there's unemployment, and then we move over to point 3, we're back into long run equilibrium. That happened all by itself, which is why it's called a self-correcting mechanism. So long before we had a Federal Reserve, and long before we had the concept of fiscal policy, where the government would increase government expenditures or adjust taxes, the economy would snap back on its own. We'd go into recessions. A lot of them were caused by banking collapses. We had a horrible banking system and currency system in place, starting from the Revolution all the way up until about, the early 1900s. And likewise, we also had, for example, just reversed the whole process. And I often don't show both directions, but what happens if we have a jump in aggregate demand? People become very optimistic. The stock market shoots up dramatically. Well, if we start at this point, the aggregate demand curve jumps up. We're at point 2. We're above full employment equilibrium. There's pressure on prices and wages are likely to increase. And so people expect a higher price level. And so they expect a higher price level as aggregate supply curve shifts back, and then we're back at the long run equilibrium. Now let's look at some other types of shocks that we can experience. Now before we do that, let's take a step back and look at what we just analyzed a minute ago. We just covered an aggregate demand shock, and we saw the self-correcting mechanism at work that brought us back to equilibrium. And that's the point. We got back to equilibrium with that demand shock. Now let's look at an aggregate supply shock, and what we're going to see is something interesting. We're not going to see the self-correcting mechanism. And this is one instance where it becomes very difficult to manage the economy when we get hit with a supply side shock. And what do I mean by a supply side shock? Like an example, well, we got hit twice in the 1970s with OPEC. Oil price increases. Oil obviously is an input, right? Do you remember back when we covered the basic supply curve for a firm, that when input prices increased, the supply curve went up to the left? That's what's going to happen in the aggregate economy. So we go from short-run aggregate supply curve 1 to short-run aggregate supply curve 2. And we go from point 1 to point 2. And what happened here? Well, remember, this is full employment, and so look at this. This has to be unemployment. Some would refer to this as a recessionary gap. And a recessionary gap when we have high unemployment. So we have inflation, we have unemployment, right? And then look what happens. You're going to have employers seeing that wages are going higher, that prices are going higher because we just see them going higher. And so they're going to have to increase wages for employees eventually. And so wages are going to go up. And so what we end up having is what's called a wage price spiral. And what happens with this wage price spiral is, look, you got inflation, we get unemployment, we get higher wages, we sit right here. And then the expectation would be that, look, there's going to be even more inflation, unemployment, and higher wages. And we get into this spiral. So we end up at point 3 at a short-run aggregate supply curve 3. Eventually, that kind of dies down. Another term, the expectations died down, and we eventually get back to a long-run equilibrium. But the point is it takes a long time to do that. This is often called stagflation, where we have a stagnant economy with unemployment, but prices are rising. Like I said, that's a really hard thing for policymakers to handle. Because look, if you want to stimulate the economy, say you want to reduce interest rates. Well, if you reduce interest rates, you move the aggregate demand curve all the way up here. Look at that. You get even more inflation. The same holds true if government expenditures increase. Government expenditures are going to move the aggregate demand curve up and out this way. You get higher prices. The only thing that would work in this scenario would be if you cut business taxes. You cut taxes for firms, and well, that reduces their input costs, and you can move down here. And that's a very controversial issue. A lot of people are against cutting taxes for businesses, but it ultimately leads to a stronger economic environment in any case. Now you might ask, what did the Fed do in this? Well, when we got hit with an oil price shock here, we moved up to this area. The thought would be, from a central bank point of view, is like, we have high inflation, we're getting inflation, we need to actually raise interest rates to head off an inflation spiral. And if we raise interest rates, well, all else being equal, that's likely to move us down to a lower aggregate demand curve. That would help reduce inflation, but it would bring us, we'd be moving down somewhere here, even a worse unemployment scenario. It turns out a really interesting story. And Bernanke, the former Fed chairman, before he became a Fed chairman, was a Princeton professor specialized in monetary economics and economics in general. He had a paper that said, look, the problem is with is part the Fed. When we had this oil price shock, the Fed increased interest rates in response to the shock. Now, you would normally think that if they raised interest rates, it would move us out to the left. It didn't necessarily, because here's what happened. We have nominal interest rates equal real rate plus inflation expectations. So let's say inflation expectations went up 3%. That would mean the Fed would have to raise interest rates at least 3%, even more, to be able to raise the real rate. So they would have to raise interest rates, say 5%, to get this real rate up. And it's the real rate that would kind of bring back down consumption and investment so that we get rid of this inflation. But what the Fed did was it kind of prolonged the situation in that, let's say inflation went up 3%. It increased the target Fed funds rate. It increased Fed funds rate 3% and left this unchanged. Well, if you leave this unchanged, what the Fed did was basically nothing. It didn't change the real rate. And so we ended up in this pattern with no corrective mechanism to try to get inflation down. That's probably what would have happened. It's counterfactual, meaning we don't know what would have actually happened back then. But if the Fed did actually raise real rates, you know what happens. It's going to bring this aggregate demand curve down to some extent. Now, like I said, the only way to try to get ourselves out of this problem is to cut business taxes, which lowers input prices and kind of brings the aggregate supply curve out and down to the right. Now, if you look at what I've been discussing so far, I looked at an aggregate demand shock, which was negative, and now I'm looking at a supply side shock, which is negative. There are occasionally positive shocks. And one, for example, was the end of the 1990s, the dot-com bubble, when the stock market was absolutely on fire. It was going up, 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 as the internet started to come into play and companies started to get on the internet. And they started selling products online for the first time. And people were thinking, wow, this is going to be huge. And so they drove up stock prices, and there was euphoria in the economy. And so what happened was the aggregate demand curve shot up like this. And then eventually what the Fed had to do was the Fed had to pull the punch bowl out, as they say, to stop the party, and raised interest rates. And when they raised interest rates, it brought the aggregate demand curve back down. The problem is it brought the aggregate demand curve back down so much that it actually brought it down too much, because we were in a stock market bubble. It popped the bubble, and wealth dropped dramatically in the country, because wealth is made up of stocks and bonds and other assets, including real estate, and those markets dropped down significantly. So we went up, And then we came down and we went too far down. And then 9/11 hit and things got even worse. And so we went into a recession. Thankfully, it was a minor recession. It wasn't a very big recession. But nevertheless, it was. We went from euphoria down to something into, higher unemployment. So those are examples of the type of shocks we can have, how to deal with them, and then how maybe not to deal with them at all with the self-correcting mechanism. So now what I want to do is I want to critique this aggregate supply and aggregate demand model briefly and just look at some data to see whether or not what I'm saying makes any sense. So my point of this exercise is just to get a little better feel for the model in terms of reality, and in the process critique the model. So one of the interesting areas that we're looking at here, and I think an interesting point, is you see this P? It's a price level. Okay, it's a price index. It's the aggregate price level. It's either deflator or the CPI. And the thing is, what we're seeing is, look, when we move up and down here, it's the price level goes up or the price level goes down. Well, wait a second. Price level goes down. That means actually deflation. We often don't have deflation. We have disinflation frequently in the past 50 years. Disinflation means we have positive inflation, but it's growing very slowly. That, it was high and then inflation starts to slow down, but it's still positive increases in prices. Here, we have the price level and we're actually showing deflation. Well, how does that come about? Well, that came about because of what Keynes saw in the 1930s. And I'm going to show you a graph in a few minutes as to what he saw and experienced with the economy, especially in the 1800s when we didn't really have a good banking system and a solid currency. So what other models, there's various aggregate supply and aggregate demand models in the world out there in economics. And one of them has, instead of the price level, it has inflation here, which kind of makes sense because most of the time inflation is positive, right? And so you got high inflation, you come down, you got low inflation, but it's still positive. You still got rising prices, but they may be rising 2%, 5%, 10%. So it kind of makes sense that we have inflation here. But when you use the price level, you basically get to the same end result. And so the general economics textbooks that we have, and the way it's generally taught at an introductory level, is this is the price level. Now, I teach a financial markets and institutions course, and in the texts that I use, various texts, they use inflation on this axis, and they have inflation not only because it's slightly more realistic given the real world, but what's interesting is they build, since it's a financial markets and institutions, and the Fed is a huge institution, what happens is the Fed is built into the aggregate demand curve. So when inflation goes up here, you end up moving this way on the aggregate demand curve. You start moving up because the Fed, when it sees inflation going up, it raises interest rates. In fact, it raises interest rates faster than the growth we see in inflation in order to get this real rate up. Okay, that's the important point. So the real rate goes up. And so you start moving up in this direction when you have inflation. Inflation comes down, you move down along demand curve because the Fed is likely to lower interest rates. And so there you have an alternative model that makes sense, but it's really specific for modeling the central bank and understanding how the central bank works. So now let's go look at some PowerPoint slides from FRED, the Federal Reserve Economic Database, briefly, to see what Keynes saw back in the 1930s in terms of prices, for example. What did he see here, and what do we see here now? So here we have two indicators of aggregate price inflation since the 1940s, the late 1940s. We have the CPI, the Consumer Price Index, and the GDP deflator. And as I was telling you earlier, they're fairly correlated. And there you have them. And so here's the shaded areas are recessions. And notice what happens. Let's start around the 1970s here. You see, before we go into a recession, strong economy. So we're above potential in a sense. Then we hit a recession, inflation comes down, this is disinflation. So this is higher inflation and this is disinflation because the inflation rate's still positive. Right here in around 1950, we actually had negative inflation or deflation. We had a little deflation here, and then the last time we had a deflation was in around the Great Recession. But notice the systematic patterns here. Before, we have really strong economies, and then things bubble over. We get asset price bubbles. We get too much lending in the banking market, and the Fed eventually pops those bubbles, raises interest rates. The economy drops down. The price level deflates a bit and drops, and then it comes back up, and it comes back down, and it comes back up, and it comes back down. Also, the thing you want to notice here is here's the recessions. They're fairly far apart here, and what you see here is you see a downward trend since the late 80s, or since the early 80s. I'm sorry, the early 80s. You see a significant drop of inflation coming down. Look, inflation at this point was 15%. Here it comes down. It stays steady at around 2.5%, and now in the past 10 years, it's remained steady, relatively steady at around 2%. Okay, now keep in mind, so keep this picture in mind. Let's go to a 70-year period, because this is approximately 70 years. Let's look at a 70-year period in the 1800s. Now, the data is not that good, but nevertheless, we kind of have indicators of what the prices look like. And look what we have here. And the first thing that should blow your hair back is look at all the shaded areas that we have. Look at all those recessions. Whew, compared it. Again, let me back up a second. Here they are. It's a 70-year period. We've got small, thin lines and a few recessions. And here we have, nearly equal amount of recessions as we do economic, positive economic activity. And here we have the price level. Okay, so part of the, look at the price level. The price level goes up and the price level comes down. This is disinflation, or I'm sorry, deflation. This is deflation coming down here. And then, this is literally called the Great Deflation. We have a long depression. We have the second industrial revolution. This is sometimes called the Great Price Sag. But actually wages went up, believe it or not, because productivity went way up when we had a second industrial revolution. Then we had World War I. We had a spike in prices. And part of this is we went on the gold standard. We went off the gold standard at various times. And we ended up in the Great Depression. And, so you're seeing prices positive. You see they're always positive, but you're seeing actually negative inflation frequently. That's what Keynes saw when he built his model, and that's why he used the price level on the index, on the y-axis of our graphs. So I hope this was informative. I think what you also should see is, look, we've come a really long way in economics. If we've gone from an economy that looks like this looks like a disaster. And like I said before, this was mainly due to not having a solid currency. We didn't have a central bank until 1913. And even then, people didn't really know how to use the central bank properly. It actually caused a greater Great Depression than if we didn't have a central bank. But nevertheless, look, things have gotten really much, much better, as you can see here.